Welcome, market participants, to another Three Things in Credit. I'm Van Hesser, Chief Market Strategist at KBRA. Each week, we bring you three things impacting credit markets that we think you should know about. Welcome to year-end volatility. With broad consensus that some sort of stock market correction is overdue, this week brought us that bump in equity volatility that figures to be with us for a while. CNN's Fear and Greed Index tracks a compilation of 7 different indicators that measure some aspect of stock market behavior. They are market momentum, stock price strength, stock price breadth, put and call options, junk bond demand, market volatility, and safe haven demand. The outcome ranges from 0 to 100, 0 being extreme fear, 100 being extreme greed. Right now, that reading is 8, solidly in the extreme fear bucket. 6 of the 7 indicators are individually in their respective extreme fear buckets. The lone one that isn't, market volatility, is merely in its fear bucket. Okay then. This week our three things are: 1. Home Depot's warning. Consumer durability is under pressure. 2. Private credit growth. Tracking leveraged finance growth is more relevant. And 3. AI bubble and credit. Much needed perspective on the topic of the day. All right, let's dig a bit deeper. Home Depot's warning. So we talked last week about the surprising strength of Q3 earnings, expected year-over-year growth of 15%, roughly double consensus coming into the releases. And it's not all just big tech. Ex the Mag 7, earnings for the S&P 493 were on track to grow at a still healthy 9%. Results had clearly benefited from reduced uncertainty on trade policy, on interest rates, on economic growth. Visibility into all of those had increased over the past 6 months, and consumers and businesses responded accordingly. So Home Depot reported same-store sales well below inflation and flat earnings that missed the consensus estimate by 3%, primarily due to, quote, lack of storms in the third quarter. Okay, as a recovering bank analyst, I guess I didn't realize just how important Mother Nature is to Home Depot. But more ominously, management cut its full-year 2025 EPS outlook from down 2% year-over-year to down 5%. That was unexpected, and the stock shed 6%. We believe that consumer uncertainty and continued pressure in housing are disproportionately impacting home improvement demand. That comes from management. The U word, uncertainty, is something that is being referenced less and less these days. Unemployment is low, wage gains exceed inflation, wealth effect is high. All are things that should help boost demand for home improvement. Sure, restrictive mortgage rates have depressed home building and home purchases, and it sounds like renovation of home purchases exceeds the value of home improvement, but this warning is signaling something more. This feels like slowdown at the middle and lower income strata of households, where the cumulative effects of inflation and tightened credit are leaving more of a mark, and where anxiety over job security is building. Home Depot danced around this in the following way. We still believe we have one of the healthiest consumer segments in the whole economy. But again, the economic uncertainty continues largely now due to living costs, affordability is the word that's being used a lot, layoffs, increased job concerns, etc. Management elaborated, adding that the most important factors driving demand are home price appreciation, household formation, and housing turnover, and all three are under pressure. They estimate as much as $50 billion cumulative underspend in normal repair and remodel activity in U.S. housing. Housing doldrums, we believe, is among the top priorities to be addressed from a policy standpoint. As we have said in the past, we think it could drive a December rate cut, as well as support for some type of fiscal stimulus, ultimately from the White House. All right, on to our second thing, private credit growth. Now, I have to admit, as an experienced financials analyst, go ahead with your chorus of "okay, boomer," I bristle a bit when private credit is referred to as something new. It's not. Right? What's changed is where it resides. In the now distant past, something experienced financials analysts know, private credit resided largely on the balance sheets of banks and what we used to call commercial finance companies. You know, General Electric Capital, CIT, Heller, Finova. Okay, you might not know. Trust me on this one. Then the GFC happened, and the vulnerability of those holders was exposed. The banks, in times of stress, would cede control of their accounting marks to adversarial regulators, resulting in write-downs that would gap lower. Your commercial finance companies would lose access to increasingly market-sensitive funding. From an economic perspective, you got credit crunch for riskier borrowers. So policymakers and markets pushed riskier lending largely out of the banks and commercial finance companies and into the private capital marketplace. In doing so, as we have said many times, you diffuse risk by moving from concentrated, vulnerable, volatile holders into a multitude of institutional investors via alternative asset managers. And you fund illiquid assets in a much more appropriate way with long-term locked-up money. All of this is positive evolution from our perspective in the capital markets. But what about growth? Too much money chasing too few deals? Well, the data does not support that. Over the past 10 years, leveraged finance, collectively high-yield bonds, leveraged loans, and direct lending, has grown 6% on a compound annual basis compared to 5% for all corporate lending, which includes bank, commercial, and industrial loans, and investment-grade bonds. And that 6% is not out of line for an economy that has grown nominally at 5% over that same time frame. No irrational exuberance there. Leveraged finance as a percentage of GDP in 2015 was 15%. Today, it's 16%. No irrational exuberance there. What about leveraged finance as a percentage of total commercial lending? Well, that was 30% in 2015, and today it's 31%. No irrational exuberance there. So we've also long talked about how having the world's most effective capital markets, decentralized and markets-based, have been an important element in the U.S. exceptionalism story. That means having robust but not irrationally exuberant below investment-grade markets that reach innovative growth companies, flush out poorly performing zombies, and fuel active change of control markets, all of which are important to a high-performing economy. All right, on to our third thing, AI bubble and credit. So there's lots of talk these days of bubbles, and most of that is centered on the prospect of an AI bubble. At KBRA's annual Bank Symposium this past week in Washington, D.C., Jim VandeHei, co-founder of Axios, and always an illuminating voice of reason in my opinion, weighed in on the topic this way, and I'm going to paraphrase. To assume AI is a bust, you have to assume that a group of companies, collectively the economic size of Germany, is misguided. In addition, you have to assume that China and all of its companies is also wrong. His point is that the technology will be transformative, even if the details, the magnitude, and the timing are very much open to debate. He also believes that the impact of this is likely to be sooner than expected, something the market and ourselves increasingly agree with. Some viewpoints out this week on the topic we think are instructive. Goldman Sachs economics research acknowledges that the present discounted value of the capital revenue from AI for the U.S. economy is, quote, highly uncertain, but our baseline estimates are for around $8 trillion with a plausible range of $5 trillion to $19 trillion. The baseline assumes a 15% uplift to U.S. labor productivity and GDP following full adoption. It adds that those benefits are enough to justify current and anticipated levels of investment spending. In fact, the firm points out that AI spending today at less than 1% of GDP is smaller than in previous large technology cycles, which reached 2 to 5% of GDP. Recall a couple of weeks ago that John Gray at Blackstone provided a back-of-the-envelope rationale that came up with $9 trillion of value globally if AI drives a 15% reduction in costs. Deutsche Bank points out that AI is already a spark, accelerator, and source of fuel for economic growth, even before it significantly moves the needle on productivity. It identifies 5 ways AI is driving the economy, namely technology-related investment, which shows no sign of stopping, boosting the wealth effect, reducing market friction, or what The Economist magazine refers to as the rip-off economy, reallocating winners and losers, and yes, productivity gains. Now, there are a lot of puts and takes here, but ultimately, its base case sees a productivity enhancement of 0.5% to 0.7% a year. And what does this mean for credit? Well, the good news is that the economy has benefited materially in 2025 from AI-related investment. Absent that growth engine, the U.S. economy would have seen growth slow to stall speed, or worse. Safe to say that credit spreads would not be sitting at or near multi-decade tights without the benefit of AI. Over the near term, as market participants try and dimension the unknowns, expect volatility to remain elevated, and that alone should put modest upward pressure on credit spreads, as will deteriorating credit metrics, albeit to varying degrees, of the large technology firm debt issuers. Crowding out in debt markets is also a very real threat. Competition for fixed income investors in both rates and credit markets will increase under the weight of funding the U.S. fiscal deficit and the AI boom. So there you have it. 3 things in credit. 1. Home Depot's warning. It points to pressure on middle to lower income households. 2. Private credit growth. It's in line with historical standards. And 3. AI bubble and credit. It remains an important economic growth engine. As always, thanks for joining. Don't forget to check in on KBRA.com for our ratings reports and our latest research. For those of you in the States, enjoy Thanksgiving. We'll see you in a couple of weeks.